Okay, everybody, good morning. June 24th, our latest installment of the Mortgage Monday call series is underway. For those of you that don't know, my name is John Mooney. I'm one of the area managers here for Guaranteed Rate Affinity. My co-host has his webcam fired up over there. That's Aaron Wise. Good morning, Aaron. How are you?
Pretty good. Good morning.
Outstanding. So crazy to think that in 5 days, Q2 is over and we are beginning the second half of the year. We started we have the longest day of the year, and summer has officially started as of last Friday, so we love that. And coming to you again with our Mortgage Monday call series. So this is a quick 20-minute live call that we do on the second and fourth Monday of every month. We do send out a recap afterwards that has some links to some of the articles and programs that we discuss. It also has a quick summary of the call itself. And it also has a link to this actual full video that we are underway with right now. So if you have friends, colleagues, clients that you think might benefit, by all means, forward it on to them. This is a free value add for everyone. Something you guys can tap into when you're out on the road, in the car, at a coffee shop, and just kind of keep your saw sharp as it relates to home financing to help grow your business. So Aaron, any opening remarks for you before we get into the data?
Yeah, a couple big things. This is volume 10 for us. So this is our 10th edition, which is kind of cool. It's also about 65 days until the NFL season starts. I'd like to point that out. Obviously, very important pertaining to business. And yeah, I'm ready to get started. Let's do it.
For those of us here in Chicago, we know that this city is a different place when the Bears are good, competitive. We have something to be positive about with the Bears. So this is very much true. So what have we seen since the last 2 weeks from our call? Rates continue to slowly grind down, okay? The Fed has not cut. They have not signaled if and when they're going to cut. The market seems to have priced in one, maybe two cuts between now and the end of the year, okay, which is a revision. At the beginning of the year, they were expecting 4 to 6 cuts. Now we're looking at, say, 1 to 2. But you will notice that rates are still lower today than they were at the beginning of May, and they're lower than they were at last fall's kind of peaks around 8%. So today we're just a smidge below 7 is what we're typically seeing at the national average as far as rates go. If you're having your buyer use a first-time buyer program that we offer, or the property itself is located in a targeted area, you may see rates in the mid-6s there. And all this is without discount points, okay? So what we're seeing is that the spread between the 10-year treasury and what the 30-year fixed mortgage is, that spread is decreased, okay? There's a couple of reasons for that, but that's what we continue to see in the supply and demand aspect of the treasury market. It seems to think that we will have better yields and lower rates going into the second half of the year here, okay? So if we took the worst levels of those spreads in 2023 and we incorporated those spreads today with what the 10-year bond is doing, we would see rates about a half point higher. We would be around 7.5, but we're not. We're just a smidge below 7 because those spreads are continuing to compress, okay? That's a good thing for mortgage rates. That's a good thing for our buyers. And as much as we tell people, focus on the payment, focus on the price, when we see a 2-week run like we've had, slightly lower rates coming on board, we see mortgage applications follow suit. So as rates slightly dip, the mortgage apps slightly increase. And that's what we continue to see. So Aaron, any interest rate love you have going on out there for yourself or your clients?
You know, I think the psychological edge is everything when it comes to rates. I mean, the differential in 7.25 and 6.99 mathematically is not a lot. Psychologically, it's massive. So I've noticed a big tick up because we're starting to see, when you can tell somebody you can lock them in 6.7, 6.8, 6.9, that just sounds so much better than 7.1 or 7.2. So there is something there. It's almost, when you price a property out at 999 versus 1,025,000, you're just going to get a lot more looks at 999, right? So that's our, pricing model. One interesting note, I priced a VA loan this morning at 6.25, which is, that's the best you can get on anything right now. So that's sharp. Razor sharp. And then, man, the grants, which we'll talk about in a minute, but some of these interest rates that come along with being a first-time home buyer, and getting lower mortgage, we'll get into it in a minute, but that's the best deal in town. The grant rates and VA, best deal in town.
Absolutely. So just to touch on the VA for a second, best mortgage that's out there, right? You can finance 100%. You don't have monthly mortgage insurance. If your VA buyer is working with us at guaranteed rate, we're not going to charge them any lender fees. So they save $1,400 there as well. So if you have those VA buyers, connect them with us. We will get them set up. We will get them pre-approved. We will help the seller become comfortable with a VA offer. If they're not, we can help there. Okay. So just wanted to highlight that on the VA side of things, and just on the psychological note of things, instead of saying 7.25, maybe we say 6 10/8, right? Sounds better with that 6 handle on it, right?
Sure does.
Moment of levity here. So, moving on, we have a brand shiny, spanking new grant program, which we're very excited about. So we'll get into it in just a second here. There's no strings attached on this program. So what we mean by that is many of these grant programs that are out there, they come with strings attached. Okay, so the IDA program, for example, most lenders here in Illinois offer it. It's a great program. However, if you're taking that $6,000, $8,000 from the state of Illinois in that grant, they record a second lien on the property. Okay, if you go to refinance or your client goes to sell the property within 7 to 10 years, depending on the program, they have to pay that money back on a prorated basis. Okay, so if they close today and rates drop to 6.5%, 6% next year, they have to deal with that grant money in order to refinance. Can't roll it into the mortgage. You've got to come up with it out of pocket and pay it at the table. Okay. Not to discourage anyone from taking that program. It's a fine program. The program we're talking about today comes with a $3,000 grant. It is instantly forgiven. It's not tied to the title of the property. They can refinance, sell at any time. And it's a wonderful way to reduce the closing costs or even apply that grant towards the lower interest rates and some things we'll talk about in a second here. And there's no restrictions on neighborhood or town this can be used in. Anywhere in the Chicago MSA, which goes to Wisconsin, Indiana, all through Illinois, we can use this program. So, Aaron, tell me more about it. What do you like about this this shiny new toy?
So lately for me, it's been about giving somebody $3,000 to buy their rate down. So if we're having that conversation about the sensitivity with interest rates, I was working on one last night. Borrower is at 7 and change. We're going to use the $3,000 to buy it down and get her at like a 6.49. So it was about a 0.5 point buy down, which is a huge chunk. And so it was enough to, essentially let her know she's getting a discount. I mean, everybody just wants a win right now. They want the W. So what comes along with that was she was doing a 10% down scenario. So you've got less expensive mortgage insurance. You've got just a lower rate, period. And then you've got $3,000 to help buy that already lower rate down further. You're getting the best of everything. So that's essentially, I was going to say the spin, but there really is no spin. Those are the facts of how you can do it. You can use it for closing cost credits if you want, but you can use those credits to help buy the rate down, which is a big deal right now. So.
Yes, so question in the chat here, there is an income restriction on this. So the area median income here for Chicagoland is 109,000, okay? This program actually goes to 140% of that income threshold. So it takes it up to about 156,000, okay? So that's the cap on qualifying income. They can use this to purchase anywhere. There's no restrictions on neighborhood, town, census tract, nothing like that. Aaron's example, I mean, gives a lot of bang for your buck. Okay, so on the one hand, yes, we can use this 3,000 just to eliminate closing costs. They can keep 3,000 in their bank account, pay for the moving expense, pay for the paint in the living room, whatever they're going to use the money towards in their life. They can certainly reduce their bottom line, use it that way. The example Aaron's talking about makes a lot of sense. If you go from 7% down to say 6.5%, okay, and let's say it's on a $450,000 mortgage, you're going to save about $120 a month. Okay, that adds up quickly. So in the first year, you're saving $1,400. Over 5 years, that saves $7,200. And every year that goes by, you're saving another $1,400 by applying that 3,000 that we took at the closing table to get that rate down to 6.5 from 7, just as an example. Okay. Other things you can do with it, I mean, you can use it to pay the PMI in a single premium. So you can put less than 20% down. Use this credit to eliminate the mortgage insurance, and then from day one, there's no mortgage insurance on your conventional loan using this program. Okay, so you know, $3,000 can go a long way on this kind of stuff, and it's really exciting, right? So we're starting to see these guidelines start to loosen up a little bit. It's able to apply to more people in more situations. You know, IDA program, for example, you've got to be 80% of AMI. That comes to 87,000, give or take, right? We're talking about doubling that, which casts a wider net, which allows more people to take advantage of it. And it's instantly forgiven. You don't have any clawback or proration going forward. So it's a new no strings grant program. We're excited about it. Feel free to introduce us to your buyers or ask us questions offline. Happy to join any team meetings or jump on a call with yourself or anyone that wants to learn more about it. Anything else on the grant program before we move on, Aaron?
Yeah, I've got one final note on that. There is a buyer that I've got that is going to qualify for this. And when I let their agent know, excuse me, their agent specifically made a note that they can use those funds towards any type of inspection issues, excuse me, that come up. So right now, inspection issues, I don't know about you, John, but I'm seeing this across the board. Everybody's selling as is. And if you've got $3,000 extra to spend on, you know, big ticket items that have popped up in inspection, it just makes that conversation a hell of a lot easier. So again, she basically, the agent was going in saying, hey, we have an offer, we're putting this in, we're trying to win, we're going to go as is, but she was using the $3,000 with the buyer to shape the transaction and say, hey, listen, if anything comes up on this inspection, your lender's giving you $3,000 to go towards this that you wouldn't ordinarily have. So it's really about finding that hot button, I feel like. You know, is the buyer's hot button an interest rate hot button? Is it a payment hot button? Or do we need to wait for the inspection results to come through? And now all of a sudden we've got a, you know, a $2,500 issue that we can't seem to figure out. Well, then we've got an inspection hot button. Either way, that $3,000 is kind of coming in. And I don't want to say it's saving the day, but it's definitely helping cushion the blow a little bit. So I think it's about how you sort of frame it and, you know, what that buyer is really looking for as far as needing those funds or wanting those funds. So.
Absolutely. Every bit helps, right? So, one thing just to touch on, that's an update on the FHA side of things, right? So, as it pertains to FHA, those interest rates are typically lower, right? So FHA and VA typically have lower rates. However, they carry mandatory mortgage insurance on the FHA side, and there's a funding fee as well, okay? However, what we're starting to see is some of the guidelines loosen up on qualification on the FHA side. Okay, so one of the things that was a nice win for that market is that they no longer have donor ability. Okay, so what donor ability is, you know, FHA was designed for first-time home buyers, although you don't have to be a first-time buyer in order to use it. There's a lot of circumstances where that buyer is getting gift money from a relative, spouse, parent, you know, something like that. And for the last maybe 5 years or so, in order to get that gift money, we had to source the bank statement of the donor in order to use those funds at the table. So we needed a 30-day bank statement that was required by FHA in order to use gift money, okay? Today, that requirement is no longer. So we still have to source where the money came from with a copy of a check or transaction receipt, but we're no longer having to get a 30-day history from the donor, which is a nice pickup, okay? So we're starting to see those guidelines loosen up slightly. They've also defined what a large deposit is in the FHA world. So that used to be a little nebulous. Now they've come out and clearly said it's 50% of the gross qualifying income. If there's a deposit in the bank statements that we see that exceeds that, we have to source that money. But if the deposit is less than 50% of the borrower's qualifying income, then we no longer have to source that money, which is a nice pickup as well. Okay, so every little bit helps, right? Couple other things that we talk about on every one of these calls. We are coming up to the 20-minute mark here, so we will wrap it up here shortly. But we do soft pulls when we do an initial pre-approval. So in today's market, when things can happen so quickly in terms of multiple bids, house hitting the market, you might be competing with cash. You might need to close in 2 weeks. So it's never too early for the lender to have a conversation with your buyer, even if they don't plan to purchase until fall, next spring. It's a soft pull on credit. So there's no downside to the buyer taking a look. However, in order to get a true bona fide loan approval through underwriting, they need a hard pull for those, okay? What we've been seeing for the last 3 years or so, when volume has decreased, the credit bureaus are selling the client's information to other online call center based companies. So I talk to clients that do a hard pull on credit, and for 2 weeks, they're getting spam calls, texts, emails, multiple a day, in some cases, double digits every day. There's a petition that we will include in the recap to this call that'll go out, or there's a petition to stop that. We would like Congress to step in and stop the credit bureau's ability to share our clients' information. It's not cool, and the client never authorized it. So take a look in the summary that we send out, sign the petition. There's another petition that'll be in there to help halt the purchasing of single-family homes by institutional investors and firms. So BlackRock, the big Wall Street firms out there, are buying single-family homes for long-term rental purposes. It is out there. It's not a ton in Chicago, but other places in the country, it represents sometimes up to 25–30% of home purchases. Okay. I personally believe that homeowners and people should own houses. So take a look in the summary that we send out. If you feel the same way I do, we'd love to see your support on those petitions as well. And last but not least, we can get into some competitive bids and how we help our clients win those situations and potentially beat out cash offers. Aaron, do you want to wrap us up here talking about the power bid and competitive bids?
Absolutely. So yeah, short and sweet. If we get going, typically when we do, or when anybody does a pre-approval, they're, glancing at W-2s, pay stubs, bank statements, the whole thing, issuing a standard pre-approval, and then they're done. I'd say, I don't know, maybe 6 to 9 months ago, we decided that we wanted to take it a step further. So where we can pull ahead here is we offer a power bid pre-approval. The term doesn't matter as much as what we're doing. Essentially, what we're trying to do is get an actual approval for your buyer. That's really what it is. So it's the difference of you putting an offer in for your client and saying, hey, listen, this client's ready to go, credit's great, the loan's not going to take a long time, et cetera, versus the loan is clear to close as long as we can get a contract and potentially an appraisal, and we'll be done. We can close in as little as 10 days. Where's your client at with that idea? Even if the customer on the selling side doesn't want to close that fast, you're essentially puffing out your chest and saying, hey, listen, we can do this if your seller wants to close super quickly, or if they want to close in 60 days, that's fine. Why don't we put together a 2-week mortgage contingency so that way your seller isn't freaking out for the next 45 days wondering if we're going to be able to come through and perform on a buyer side. So it's really simple. The only real difference there is that we're going to do a hard pull on credit, and we're going to actually have an underwriter look at those W-2s, pay stubs, bank statements, et cetera, so that way when we issue the approval, it's done. The magic on these is if we also get an appraisal waiver too. So if your customer's buying a primary residence, they're putting 20% down, there is a possibility that we can get a waiver where we don't need an appraisal at all. And if you don't need an appraisal at all, you also don't need an appraisal gap addendum in there either, because there is no appraisal. So now all of a sudden it's, hey, we need a contract, and then the buyer's going to hook up insurance for the house, and your attorney can get us title in a week, we're good to go. So it's night and day. It's not cash, but it's pretty damn close. It's cash, power bid, and then everybody else that's putting in a pre-approval. So that's your huge difference. Start chatting with your buyers about that, just how we can give them an edge, and then we'll take it the rest of the way. But if you're telling the buyer, hey, listen, this is something you can do, especially if you've lost out on 3, 4, 5 bids already, but this is going to push you to the top of the pile, they're going to listen, especially after losing a couple times. They're going to be listening a little bit more keenly than they were before. So that's the deal.
Yes, sir. So there's, I come back to let's control the controllables, right? If our buyers being asked to potentially waive finance contingency, appraisal contingency, or appraisal gap, contract and inspection contingencies, we want to control the stuff that we can control. Okay, so if they're being asked to potentially waive finance contingency, we can do that. We've done the homework up front. They have a commitment letter from us, which is basically a proof of funds. Okay, and especially going into August, right, when the commission settlement kicks in or is expected to kick in, I would consider this part of your value proposition that you offer your clients. You can get them an approval letter that's essentially as good as cash, and they can close in a week to 10 days at a minimum, or they'd be a lot more comfortable waiving some contingencies to have their offer strengthened and stand out from the crowd. This is all the tools and empowerment they can get, your clients can get, by working with you and partnering with us. So control the controllables and leverage your clients to win. Okay, so Coming up here on 26 minutes into the call, we are going to wrap it up here. Look out for the recap that we will send out either later today or first thing tomorrow. Thank you for being on the call today. We value your partnership. We want to be a resource for you. We will see you on the next session, which is actually the 8th of July. So on behalf of Aaron Wise, John Mooney here at Guaranteed Rate, thanks for being on the call. Mortgage Monday, June 24th. See you in a couple weeks, everybody. Make it a great one.
Thanks, guys.